Every system tells you the same lie, that money is neutral, that markets are fair, that if you work hard and save, you'll keep what you earn. History says the opposite. From ancient Rome to modern stock markets, the biggest wealth transfers don't happen by accident. They happen through rules, crises, and policies that quietly move value from one group to another, from savers to debtors, from workers to asset owners, from the poorly informed to the highly connected. Most people only notice when it's already too late. We like to imagine wealth changing hands in open ways: a business built, a house sold, an inheritance passed down. The largest transfers don't look like that. They arrive disguised as inflation, bailouts, currency resets, wars, and rescue plans that save the system by sacrificing the people at the bottom of it. This is the story of those transfers. 15 hidden facts that show how wealth really moves in a collapsing system. Simple examples. Slow decay. Then the sudden drop. Stay with it. By the time you reach the end, you will never hear the words stimulus, crisis, or rescue the same way again. Hidden fact 1. The biggest wealth transfers happen through rules, not robberies when people imagine losing everything. They picture theft, a burglar, a scammer, a hacked account. That happens. But the largest shifts of wealth in history didn't come from criminals breaking the rules. They came from people changing the rules. When a government devalues its currency, it isn't stealing anyone's wallet. It's changing what the numbers inside every wallet mean. When a central bank cuts interest rates to near zero, it isn't kicking in anyone's door. It's deciding that savers will earn almost nothing while borrowers benefit. Laws, regulations, and monetary decisions are framed as technical adjustments, made in the public interest. Most citizens never read the details. Yet inside those details is the simple reality: whoever controls the rules controls the direction of the next wealth transfer. The largest fortunes are built by understanding those rules early. The largest losses are suffered by people who assume rules never change. Hidden fact 2. Inflation is a quiet tax on the unprepared. Inflation is sold as an unfortunate side effect of stimulus or support. In practice, it is one of the oldest tools for shifting wealth away from savers and wage earners toward debtors and asset owners. Ancient Rome debased its coins. Silver content dropped, prices rose, and anyone holding savings in cash saw their purchasing power evaporate. The same pattern repeated in later empires. Spain's flood of silver raised prices. Weimar Germany's printing destroyed the middle class. Countless smaller inflations wiped out local savings. The mechanics are simple. When prices rise faster than wages, every paycheck buys less. Cash savings lose value every year. Meanwhile, people with debt see the real burden shrink. And owners of scarce assets, land, commodities, productive businesses often see their holdings repriced higher. Inflation doesn't need your permission. It doesn't knock on your door. It just quietly rewrites the value of everything you own, line by line. While most people still believe the numbers in their account mean what they used to. Hidden fact 3. Currency devaluation punishes trust and rewards exit when a currency is devalued through an official reset. A sudden crash or a long slide, the people punished most are the ones who trusted the system the longest. They kept their savings local. They held the national currency. They believed promises. Devaluations have many justifications: restoring competitiveness, reducing debt burdens, stabilizing trade. In a single announcement or a short series of moves, the real value of pensions, salaries, and savings can drop by double digits. No law says, "We are taking 30% of your purchasing power," but that's what happens in practice. Those who saw the pattern early and moved some wealth into harder assets or more stable currencies before the break, experienced the same event differently. For them, the devaluation is a transfer from the trusting to the cautious, from the static to the mobile. The cruel detail: the very people least able to move their money, small savers, pensioners, local workers, are the ones most exposed when the currency they depend on is deliberately weakened. Hidden. Fact 4. Debt booms feel like prosperity right up to the transfer, before every major wealth transfer. There is a boom. Easy credit, low interest rates, rising property prices, soaring stock markets. People feel richer. They can borrow against homes, buy cars on installments, swipe cards for things they couldn't previously afford. Politicians point to rising GDP and call it success. Debt creates the illusion of extra wealth. It pulls future spending into the present. As long as confidence holds, the system looks healthy. Businesses expand. Cities grow. Consumption surges. Then the cycle turns. Rates rise. Payments become heavier. Overstretched borrowers start to default. Asset prices fall. In the cleanup phase, ownership changes. Lenders seize collateral. Stronger firms buy weaker ones at discounts. Investment funds with dry powder scoop up property and businesses from distressed sellers. The boom was never free. It was a setup for a transfer. During the good years, debt quietly arranged the terms of surrender. When the downturn arrived, the contracts decided who lost everything and who went shopping in the ruins. Hidden fact 5. Crashes transfer assets. Not just numbers. Market crashes are usually described in points, percentages, and headlines. Stocks fall 30%. Housing prices plunge. Behind those statistics, real transfers happen. When a house price drops below the amount owed on the mortgage, the owner has a choice: keep paying into a losing position or walk away. In both cases, someone else eventually acquires that property at a lower real cost. When a business's share price collapses, long-term holders may panic out near the bottom, selling to buyers who still have cash and patience. Wealth doesn't vanish in a crash. It changes hands. The building still exists. The factory still produces. The land still yields crops. What changes is the ownership structure. A large group of small holders are shaken out. A smaller group of concentrated holders take control. On charts, this shows up as a line that falls and then recovers. In life, it shows up as families losing homes, small investors losing savings, and larger players quietly expanding their portfolios using the same cash they kept safe while others chased the late-stage highs. Hidden. Fact 6. Bailouts preserve the system by sacrificing the bottom when institutions are too big to fail. Saving them becomes the priority. The justification is simple. If they collapse, the entire financial system could break, hurting everyone. So governments and central banks step in with guarantees, loans, asset purchases, and emergency programs. The rescue is not free. Public money backs private losses. Bad bets are absorbed into the balance sheet of the state. Meanwhile, smaller businesses and ordinary households rarely receive the same scale of support. They are told to tighten belts, accept austerity, or declare bankruptcy. The net effect: risk is socialized while long-term control remains private. The institutions that helped cause the crisis survive, often becoming even larger and more dominant. Those without lobbying power or systemic leverage are left to sort themselves out. Each bailout is framed as preventing collapse. Each one is also a wealth transfer. Losses spread outward to taxpayers and currency holders, while core assets and influence stay with the same hands. Hidden fact 7. Tax systems quietly reward capital over labor on paper. Modern tax codes look neutral and fair. Brackets. Deductions, corporate rates, sales taxes. In practice, they create powerful incentives that favor certain types of wealth over others. Income from wages is usually simple and visible. It's taxed at the source. There are few deductions. Workers pay before they see their full pay. Capital, on the other hand, in the form of businesses, real estate, and investments, often benefits from different treatment. Lower rates on gains, allowances for depreciation, the ability to offset losses, and more complex planning options. Over decades, these differences compound. A person who relies purely on salary will find it hard to escape the tax net. A person who can shift income into capital gains, ownership structures, or long-term holdings has more room to keep and grow wealth. Nothing about this looks dramatic in a single year. Over a lifetime, it is one of the most powerful legal wealth transfers in existence, from the heavily taxed worker to the lightly taxed owner, all without a single law ever using those words. Hidden fact 8. Financial repression turns savers into silent donors. Financial repression is a technical term for policies that keep interest rates below inflation for extended periods. It sounds abstract. Its effect is very simple. People who hold cash and low-yield savings lose purchasing power every year, even as their nominal balances stay the same. Governments favor this when they are heavily indebted. Letting inflation run slightly higher than interest rates erodes the real value of that debt over time. It is less politically explosive than explicit default or sharp tax hikes. The cost is spread out and hidden. Who pays? Savers, retirees, conservative investors. They see their nest eggs earn small returns while prices climb faster. Who benefits? Large debtors, including the state itself, and sectors that can raise prices or obtain cheap financing to buy real assets. This is a wealth transfer in slow motion. No one announces it. No headline says, "Your savings will be drained to stabilize public books." But year after year, the real value moves. Hidden fact 9. Wars are the fastest way to rearrange ownership. War is the most brutal form of wealth transfer. Cities are destroyed, factories bombed, farms burned, shipping lanes disrupted. Human lives are the greatest loss. Behind that, another pattern plays out. Ownership is forcibly reset. Governments often fund wars through debt and money creation. After the conflict, currencies are revalued, debts are inflated away, and land or businesses change hands through confiscation, reparations, or simple abandonment. Old fortunes disappear with regimes. New fortunes belong to those who control reconstruction, construction firms, suppliers, financiers, and politically connected insiders. For ordinary people, the war is loss. For a small group close to power, it is opportunity. The post-war era is often remembered as rebuilding or recovery. It is also a multi-decade redistribution of who owns what, under the cover of necessity. History records borders moving. It rarely lingers on the millions of individual balance sheets wiped out and rewritten in the process. Hidden fact 10. Technological shifts create new elites while erasing old ones. Every major technological wave triggers a wealth transfer, from industries built on the old paradigm to those built on the new. The printing press reshaped who could profit from information. The Industrial Revolution made factory owners and broke many small artisans. The digital age rewarded code and networks while undermining traditional retail and media. This looks like progress, and in many ways it is. Productivity increases. New services appear. Lives improve. But the transition period is harsh for those whose skills and assets were tailored to the old world. Owning farmland meant power before factories. Owning factories meant power before software. Owning software and data means power before whatever comes next. Each shift takes wealth away from people who are deeply invested in yesterday's tools and transfers it toward those who understand tomorrow's. The pattern is unavoidable. What's avoidable is pretending that the old order can be protected forever. The more a society tries to freeze obsolete structures in place, the harsher the eventual transfer becomes. Hidden fact 11. Demographics decide. Who pays and who collects wealth transfers are not only about classes and sectors. They are also about generations. Pensions, Social Security, healthcare promises, and long-term public debts all have the same underlying structure. Someone in the future will pay for commitments made today. When populations are young and growing, the burden can be spread across many workers. When populations age and birth rates fall, ratios flip. A smaller working generation is expected to support a larger retired generation through taxes, contributions, and rising prices. Promises made decades earlier may no longer fit demographic reality. Yet few politicians dare to openly reduce them. Instead, the system silently adjusts through higher taxes, lower real benefits after inflation, and later retirement ages. This is a wealth transfer from younger, future earners to older, current beneficiaries, not because of moral failure, but because the arithmetic of time and population leaves no painless option once promises have been overextended. Hidden fact 12. Crises accelerate trends that were already in motion when a crisis hits. A financial meltdown, a pandemic, a geopolitical shock. Wealth moves quickly. Some businesses fail overnight. Others grow rapidly. Some assets plunge. Others spike. It is tempting to think the crisis created these shifts. In reality, crises mostly speed up changes that were already underway. Companies with weak balance sheets and outdated models stumble first. Firms leveraged to technology, logistics, or essential goods may consolidate their lead. Policies floated quietly in normal times are suddenly passed as emergency measures. The result is another transfer. Weaker players, often small and local, lose ground. Stronger players, often large and global, gain market share, influence, and access to support. The crisis is the spotlight. The script was written in the years before, through choices about leverage, resilience, and dependence. For individuals, this means that how you position yourself in normal times largely decides how the next crisis will treat you. The event is sudden. The vulnerability was built slowly. Hidden fact 13. Information gaps are a permanent transfer mechanism in every system. Some people know more than others. They see data earlier, understand rules better, or have access to experts and networks that most never meet. This information advantage converts directly into wealth over time. Before a devaluation, insiders move money quietly. Before a policy change, those who wrote it structure their portfolios accordingly. Before a bubble bursts, some players see the flows slowing and step aside while retail investors keep buying into the peak. This is not always illegal. Much of it is simply structural. Executives know more about their industries than employees do. Regulators know more about forthcoming rules than citizens. Major investors have teams analyzing risks that ordinary people only see when it hits the news. The result is predictable. Across cycles, the uninformed subsidize the informed, not through direct payments, but by arriving late to every trend and staying late in every exit. The wealth transfer is continuous, invisible, and entirely legal. Hidden fact 14. The middle is always the primary donor at the top. Wealth can be shielded through diversification, legal structures, and influence. At the very bottom, there is little left to take. That leaves the middle, people with some savings, some assets, and some income. but no real control over policy or markets. They are the ones taxed in more ways than one. Overtly, through income and consumption taxes. Quietly, through inflation, financial repression, and reduced public services. They pay for bailouts they didn't vote for and wars they didn't design. They absorb the brunt of job losses in downturns and the cost of housing in upturns. In every major wealth transfer, whether through crisis, policy, or long-term erosion, the active donor class is the middle. The system needs their compliance and their belief. As long as they assume that this is just how it works, the transfers can continue without open force. Hidden fact 15. The simplest protection is boring and unheroic stories about wealth transfers often end with dramatic solutions, escape to exotic assets, radical bets, or secret strategies. Reality is less glamorous. No one can fully escape systemic shifts. There is no asset that is safe under every regime, every policy, every crisis, but there is a difference between standing directly under the falling bricks and stepping a few meters to the side. The consistent protections across history are simple. Not being over-leveraged when the cycle turns, not trusting a single institution with everything, not keeping all savings in a form that can be devalued overnight, not assuming that yesterday's winners will automatically be safe tomorrow, diversifying where your money is, how it's held, and what it's exposed to does not make you invincible. It reduces the chance that a decision you never voted on will wipe you out in a single move. The largest wealth transfers in history are not avoidable. They are built into how complex systems correct themselves after years of excess. What is avoidable is sleepwalking into them with all your weight on the most fragile ground. The pattern is always the same: slow, quiet erosion for those who trust blindly. Sudden, obvious collapse when it's too late to react. The message is not to panic. It is to stop assuming that the numbers in your account tell the whole story. The real game has always been about who moves first, who understands the rules underneath the slogans, and who refuses to be the default donor in the next transfer.